A significant factor is the shift in interest rates. When central banks hike these rates to control inflation, borrowing becomes more expensive. This scenario affects consumer spending and business investment, leading to a slowdown in economic activity. Higher interest rates also pose a challenge to banks' profitability. As a result, they may decide to streamline operations by closing less profitable branches, a clear survival strategy in the face of rising interest rates. Another influencer is the housing market, a key indicator of economic health. A fall in home prices means homeowners experience a decrease in home equity, affecting their access to credit and impacting the quality of loans held by banks. Mortgage delinquencies may rise, prompting banks to reassess their risk exposure. The closure of local branches can be part of a broader strategy to reallocate resources and manage risks associated with a deteriorating housing market. The commercial property crisis and delinquent commercial mortgage-backed securities, CMBS loans, pose another set of challenges. Delinquent CMBS loans create significant issues for banks when borrowers fail to meet their payment obligations. The commercial property crisis exacerbates the problem, pressuring banks to reassess their exposure to commercial real estate and make strategic decisions, such as closing branches in areas heavily affected by the crisis. Compounding these issues are instances of bank failures and unrealized losses. When banks face insolvency or significant financial distress, regulatory authorities may intervene, leading to closures or mergers. Unrealized losses on investments can erode a bank's capital base. To restore stability, banks may implement cost-cutting measures, including the closure of branches. The closure of local bank branches has broader economic implications, affecting communities, employment, and access to financial services. As branches close, employees may face job losses, communities may experience reduced access to banking services, impacting vulnerable populations. The decrease in banking infrastructure may hinder economic development in certain areas, creating a negative feedback loop that further exacerbates the situation. In essence, the current trend of bank closures is a complex issue with roots in various economic factors. It's a dynamic interplay of increasing interest rates, a declining housing market, challenges posed by delinquent CMBS loans, the commercial property crisis, bank failures, and unrealized losses. The consequences are far-reaching, impacting communities, employment, and access to financial services. However, as we navigate these challenges, it's essential to remember that change, while sometimes painful, can pave the way for innovation and progress.